Welcome to StokTok's deep dive into Elevance Health. Elevance Health is one of the largest health insurance and managed care companies in the United States, providing medical, dental, and vision benefits to millions of members through both commercial and government programs. As of May 5th, the stock is trading at $369. Over the past 52 weeks, the stock has traded as high as $424 and as low as $273. The Relative Strength Index, or RSI, is at 73.5, indicating overbought conditions where the stock may be overextended in the short term. The 50-day moving average sits at $313, while the 200-day moving average is at $323, suggesting the stock has rallied well above its longer-term trend line. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Elevance Health operates as a fully integrated health insurance and managed care provider, generating revenue from medical premiums, administrative fees, and ancillary services across commercial, Medicare, and Medicaid segments. The company's core moat, in our view, rests on scale, regulatory barriers to entry in the health insurance space, and long-standing relationships with employers and government payers. The StokTok score for Elevance Health is 40 out of 100, a caution signal. Breaking that down, valuation scores 10 out of 20, suggesting the stock may be overpriced relative to fundamentals. Financial health scores 6 out of 20, indicating material balance sheet stress. Profitability scores 4 out of 20, reflecting weak margin generation relative to revenue size. Growth scores 12 out of 20, showing modest expansion. Smart money scores 8 out of 20, suggesting institutional capital is backing away from this position. Now, valuation. The question every investor has to answer: are you paying the right price? Elevance Health trades at a price-to-earnings ratio, or P, of 15.71 times on trailing 12-month earnings. The forward PE based on next 12-month estimates is 13.73 times, suggesting some modest earnings growth is being priced in by the market. The price-to-earnings-to-growth ratio, or PEG, stands at 2.26. A PEG above 2 often signals that growth expectations may not justify the valuation premium. In our view, the EV to EBITDA multiple is 11.14 times. For context, large-cap healthcare insurance peers typically trade in the 9 to 12 times range, so Elevance appears roughly in line with sector averages on an EBITDA basis. The price-to-sales ratio is 0.41 times, which is relatively modest for a business with recurring, contracted revenue. Our DCF, or discounted cash flow model, suggests the stock is trading at a 42.57% discount to intrinsic value, implying meaningful margin of safety if the company executes as modeled. Wall Street analysts have a consensus mean price target of $389, with a high target of $474 and a low of $331, based on 21 analysts covering the name. Most analysts maintain a buy rating, suggesting they see upside from current levels. Turning to the latest earnings. In Q1 2025, Elevance reported earnings per share of $8.84, which missed the consensus estimate of $8.96. Revenue came in at $50.18 billion, which significantly missed the consensus estimate of $200.42 billion, a massive revenue shortfall that warrants immediate scrutiny. The company posted year-over-year revenue growth of just 0.9%, indicating stagnation in top-line expansion. Net income was $1.76 billion, though the margin compression is evident. After hours, the stock declined 1%, a relatively muted reaction that suggests the market may have already priced in some of this disappointment. On a forward basis, Wall Street consensus estimates earnings per share of $6.20 for the next earnings report in July 2026, with estimates ranging from $6.06 on the low end to $6.73 on the high end. Market sentiment around Elevance Health leans bearish. The company faces headwinds from a shareholder investigation and broader market volatility in the healthcare sector. Competitive pressures from rival United Health, which has recently outperformed, and geopolitical uncertainties weigh on investor confidence. The valuation presents a mixed picture. The stock looks neither cheap nor expensive in absolute terms, but given the earnings miss, slowing revenue growth, and weak sentiment backdrop, in our view, the setup does not provide compelling margin of safety at these levels. Moving to financial strength, how solid is the foundation? The Piotroski F-score is 5.0 out of 9, a concerning result. This 9-point checklist evaluates profitability, leverage, liquidity, and operating efficiency. A score below 6 typically signals deteriorating financial health, and Elevance sits right at that threshold. The Altman Z score, a bankruptcy risk model that combines 5 financial ratios, registers at 0.00, which is deeply problematic. Scores below 1.8 indicate material distress risk, and Elevance's reading is alarming. This suggests the company's financial structure carries meaningful default risk, though as a large, regulated insurer with steady cash flows, the risk of actual bankruptcy is lower than the raw score might imply. Cash-to-debt ratio stands at 0.30, meaning the company has only 30 cents of cash for every dollar of debt. This is tight and leaves little room for adverse shocks or strategic flexibility. Interest coverage, the measure of how many times operating earnings can cover interest expense, is 5.39 times, which is acceptable but not robust. A healthy industrial company typically targets 8 times or higher. Debt to equity is 0.73, indicating leverage of roughly 42% equity and 58% debt in the capital structure. The current ratio, a basic liquidity measure, registers at 0.00, which is unusual and suggests either data reporting issues or severe liquidity constraints. The balance sheet is a clear area of concern. In our view, the elevated leverage, weak cash position, and distress signals from the Z-score warrant caution. Management has not demonstrated sufficient financial flexibility, and the company's credit profile appears constrained. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 6.99%. This metric reveals how much profit the company generates from every dollar of capital deployed in the business. For a capital-light insurance business, this reading is weak. Best-in-class insurers typically generate return on invested capital in the 12 to 15% range. Elevance's return on invested capital suggests the company is not deploying capital as efficiently as peers. Gross margin is 0.00%, which reflects the nature of managed care accounting, where medical costs are not segmented separately from administrative expenses in the income statement. Operating margin is also 0.00% for the same structural reason. Net margin, the bottom line, is 2.62%. This is exceptionally thin for a $50 billion revenue business. For every $100 of premium revenue, the company is retaining less than $3 as profit. This margin compression is a structural issue in the managed care industry, where pricing pressure from employers and government payers leaves little room for profitability. Free cash flow margin is 3.22%, slightly better than net margin because working capital management and depreciation provide some cash generation benefit. However, at just 3% of revenue, free cash flow generation is modest and leaves limited capital for debt reduction, buybacks, or strategic investments. Return on equity, or ROE, is 12.03%, and return on assets, or ROA, is 4.29%. These are mediocre returns for a business of Elevance's size and capital base. The profitability picture is weak across the board. In our view, the combination of razor-thin net margins, subpar return on invested capital, and limited free cash generation represents a fundamental constraint on shareholder returns. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 8.3% annualized. Over the past 5 years, growth has been stronger at 12.4% annualized, suggesting the business has decelerated materially in the most recent cycle. The latest quarterly results from Q1 2025 showed revenue growth of just 0.9% year-over-year, confirming that expansion has stalled. This is concerning for a business in a demographic tailwind, where the aging of the population should support premium growth. The slowdown appears driven by competitive pressure, constrained pricing power, and member attrition in certain segments. Book value per share has grown at 9.3% over the trailing 3 years, which is modest given earnings retention and reinvestment. Looking ahead, Wall Street consensus expects flat to slightly declining earnings in the near term, with Q2 2026 earnings per share estimates at 6.20 compared to current run rate. This suggests management is guiding to lower earnings, a red flag. The dividend yield is 1.88%, which is reasonable for a defensive healthcare stock, but does not compensate for the growth shortfall. In our view, the deceleration from 12% 5-year growth to less than 1% in the most recent quarter is a material deterioration in the growth profile. The thesis for owning this stock relies on stabilization and reacceleration of growth, which remains uncertain. Now let's talk smart money. What institutional capital is actually doing with this name? According to Dataroma, 25 top-tier investment gurus currently hold Elevance Health in their portfolios. However, the key signal is not that they hold it, but what they are doing with their positions. Glenn Greenberg of Brave Warrior Advisors, who has Elevance as 10.28% of his portfolio, has reduced his position by 31.74%, a significant trimming that signals reduced conviction. Seth Klarman of Baupost Group, another world-class investor, holds 8.43% in Elevance and has trimmed by 3.77%. Ruane Cunniff LP has reduced by 1.78% of its holding at 7.79% of that portfolio. Leon Cooperman has made no change to his stake at 3.96%. First Eagle Investment Management has added to its position by 0.61% at 2.49% of the portfolio. The pattern here is clear. The big money is generally reducing exposure, with only one modest add among the top 5 holders. Among 13F institutional filers, only 7.4% are net buyers, meaning over 92% of institutional capital tracked has either reduced or made no change to their positions. This is a strong bearish signal. Insider ownership stands at just 2.1%, meaning management owns almost nothing of the company they run. This is concerning from an alignment perspective. Over the past 3 months, there have been 1 insider buy and 2 insider sells, suggesting even company insiders lack confidence in the current valuation. The smart money is clearly exiting or staying on the sidelines. This lack of institutional conviction is a meaningful red flag that warrants serious consideration from potential investors. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a PE of 15.71 times with a PEG of 2.26, suggesting growth does not justify the multiple, and the earnings miss in the latest quarter raises questions about forward guidance. On financial strength, the Piotroski score of 5 and Altman Z of 0 indicate material financial distress, a tight cash position, and leverage that limits flexibility. On profitability, net margins of 2.62% and return on invested capital of 7% are both well below what investors should expect from a $50 billion market cap business, and these margins are structural, not cyclical. On growth, the deceleration from 12% 5-year growth to 0.9% most recent quarter is alarming and suggests the company has lost pricing power and market share momentum. On smart money, the biggest names are reducing, insider ownership is negligible, and only 7% of institutional filers are adding. The latest earnings results reinforce these concerns. The revenue miss was severe, margins compressed, and management guidance appears cautious. Bringing this together, in our view, Elevance Health presents a complex thesis that lacks conviction at current valuation. The company has scale and market position, but faces structural profitability constraints, balance sheet stress, and deteriorating growth momentum. The smart money consensus is to reduce or avoid, and we think that signal is worth taking seriously. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Elevance Health. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.